In our strategy, we do not start with predictions. We start with how things are measured, because the measuring stick often matters more than the headline. Right now, stocks are making new highs. And on the surface, that feels like strength. But the question is, what those gains are actually worth. The video we are reviewing makes a simple but important point. Markets are usually measured in dollars, but dollars themselves change over time. If the dollar weakens, prices can rise without real wealth increasing. This is happening because more money is created than real output. And when that happens, purchasing power quietly erodes. That is why comparing stocks to gold changes the picture. Gold is not about growth. It reflects confidence in the currency system. When stocks rise faster than gold, confidence is high. When gold rises faster than stocks, confidence is being questioned. That shift is what matters here. Over the past several years, gold has outpaced equities, not because gold became more productive, but because money became less scarce. This matters now because policy support has not fully reversed, deficits remain large, and currency pressure tends to show up before earnings slow. In plain terms, this is happening because liquidity is protecting prices. And when that happens, markets can look healthy while fragility builds underneath. That is classic late-cycle behavior. In our strategy framework, this aligns with Phase 2. That is the phase where durability matters more than upside, and optionality starts to matter more than conviction. Not everything breaks in Phase 2, but fewer things work the way they used to, and relative performance becomes more important than absolute returns. This is usually when investors start asking better questions, not just how much did something go up, but what can it actually buy now? Quick note before we go further, this is educational macro commentary, not financial advice. We are explaining signals and process, not telling anyone what to do. If you find this way of thinking useful, it might be worth subscribing. Not for predictions, but for learning how different signals fit together. So you can make sense of markets without chasing every headline. Back to the signal. When gold outperforms stocks, consumers usually feel it first. Higher prices show up before incomes adjust. Equities can still rise during this phase, but leadership narrows, and mistakes tend to get punished faster. This does not mean a crash is guaranteed. Policy can delay outcomes, but delay is not the same as resolution. What changed is how we measure risk. Purchasing power matters more than nominal gains. Relative signals matter more than stories. What did not change is our process. We stay diversified across real asset classes. We protect flexibility. We do not need to be early. We just cannot afford to be late.